This is a cryptocurrency dictionary, a collection of over 100 topics that, once explored, will provide you with a comprehensive understanding of the conversations taking place in the world of cryptocurrencies. This material will explain all the most important phrases used in the cryptocurrency world. Additionally, the recording for students on the Udemy platform has been expanded to include examples of how the discussed issues are applied in practice. The link is located directly below this video. We will start in alphabetical order with airdrops. An airdrop is like a free giveaway of cryptocurrencies, distributed by a company or project. Sometimes it serves as a promotional strategy, and at other times it's a reward for dedicated users. To receive an airdrop, users need to meet specific requirements, such as owning a certain number of coins from another cryptocurrency, filling out a registration form, or completing tasks designated by the project creator. Accumulation refers to the process of gathering and holding a specific cryptocurrency for a certain period, with the hope of its value increasing in the future. It's an investment strategy where investors buy the cryptocurrency at a low price and hold on to it, anticipating its value to rise. Allocation. In the context of launchpads, allocation refers to the process of assigning a specific number of tokens of a newly introduced cryptocurrency, for example, through an initial coin offering or an initial exchange offering. Allocation is typically based on a lottery mechanism or other criteria, where participants must meet specific requirements, such as owning a certain number of coins of the given cryptocurrency or filling out a registration form to have a chance at receiving the allocated tokens. Altcoin is a term used to describe all cryptocurrencies other than Bitcoin. Altcoin is short for alternative coin, indicating that these are alternative cryptocurrencies to Bitcoin. Many altcoins have been created with the aim of improving or solving certain issues that arise in the case of Bitcoin. AML. AML stands for anti-money laundering, which means preventing money laundering. In the context of cryptocurrencies, AML refers to a set of procedures and techniques used to prevent and combat money laundering and other illegal activities, such as financial crimes and terrorism involving cryptocurrencies. Angel investor. An angel investor is a term used in investing, referring to an individual or a group of people who invest their money in the early stages of development of startups or young companies in exchange for equity in them. Fundamental analysis in cryptocurrencies operates on the same principle as fundamental analysis in stocks or other financial instruments. Its aim is to evaluate the actual value of a cryptocurrency based on its economic and technical aspects. In the case of cryptocurrencies, this analysis includes factors such as adoption level. The more people use a specific cryptocurrency, the more valuable it becomes. Use case. Cryptocurrencies utilized for real transactions or services are generally more valuable than those simply held as investments. Technology. Cryptocurrencies built on advanced and secure technologies are more valued than those that are less developed or susceptible to attacks. Resources. For cryptocurrencies based on resources, such as commodities-backed cryptocurrencies, their value can be highly dependent on the prices of these resources. Risk. Investing in cryptocurrencies involves a certain level of risk, which needs to be considered when evaluating their value. Fundamental analysis in cryptocurrencies enables investors to better understand the actual worth of a given cryptocurrency and make more informed investment decisions. However, it's important to remember that the cryptocurrency market is highly volatile, and cryptocurrency values can change rapidly. Therefore, investment decisions should be made cautiously, and it's essential to regularly monitor the market conditions. Technical analysis in cryptocurrencies is a method of assessing the value of cryptocurrencies based on the analysis of price charts and other historical data, such as trading volume or highest and lowest prices. The goal of technical analysis is to predict future price changes of cryptocurrencies based on their past behavior. Technical analysis utilizes various tools such as technical indicators, price patterns, and trend lines to assist investors in identifying buy or sell signals. Some popular technical indicators that can be used in cryptocurrency technical analysis include the Relative Strength Index, RSI, and the Moving Average Convergence Divergence Indicator. Technical analysis is especially popular among investors seeking short-term or medium-term investments. However, it's essential to note that technical analysis does not account for fundamental factors such as profits, revenues, or a company's debt level. Its effectiveness might be limited during significant market changes or significant events that could impact cryptocurrency prices. Therefore, some investors opt to use both methods of analysis, fundamental and technical, to gain a more comprehensive view of the market situation. Arbitrage involves buying and selling the same currency in different places to take advantage of price differences. In other words, if you buy a cryptocurrency at a lower price in one place and sell it at a higher price in another, you can make a profit. Attack 51%. The 51% attack poses a potential threat to some cryptocurrencies based on the proof of work system. This means that if one person or a group of people were to control 51% of the network's computational power, they would have control over the network and could carry out unauthorized transactions, such as reversing previous transactions or duplicating funds. All-time high. ATH stands for all-time high and refers to the highest price ever reached by a particular cryptocurrency in the market. This means that the cryptocurrency has achieved its best value in its history, and this value serves as a benchmark for comparison in the future. ATL. ATL, short for all-time low, refers to the lowest price ever reached by a particular cryptocurrency in the market. It stands in direct contrast to all-time high, which represents the highest price the cryptocurrency has ever attained. Understanding both ATL and ATH provides valuable insights into the price range and historical performance of a cryptocurrency. Bag holder. A bag holder refers to a person who holds onto their investments in cryptocurrencies even as their prices plummet. The term is a play on words, combining hold and bag, implying that the person continues to hold their assets even if they become worthless. Bearish. Bearish is a term used in the world of investments to describe a situation where someone expects asset prices to fall. A person with a bearish outlook is pessimistic about the market and believes that prices will decline in the near future. BEP20. BEP20 is a token standard based on the Binance Smart Chain blockchain, used for creating and managing digital tokens on this platform. It's a type of token that can be utilized for various purposes, such as representing asset value, serving as a medium of exchange, participating in projects, and much more. Bessa, or bear market, is a term used in finance, referring to a period during which the value of assets, such as stocks, bonds, or real estate, is declining. In other words, a bear market signifies falling prices in the financial market. Block size. Block size refers to the size of a block in a blockchain, the underlying network for some cryptocurrencies. It determines how much information can be stored in a single block and is a crucial element that affects the speed and efficiency of the network. Blockchain. Blockchain is a technology that enables the secure and immutable creation and storage of data. It consists of a network of records linked together in blocks, distributed across multiple users. Each block contains transaction information and is cryptographically secured, making it impossible to modify or delete without the knowledge of all network users. Blocks in the blockchain are interconnected in a chain-like manner. Each block contains transaction data from a specific moment and feedback information from the previous block in the form of a hash. A hash is a unique one-time string of characters generated based on the content of a specific block. Because each block contains feedback from the previous one, they are interlinked, forming a cohesive chain. If someone wanted to make a change in one of the blocks, they would have to make the change in all subsequent blocks, which is practically impossible. This interconnectivity ensures that the blockchain is secure and resistant to manipulation. The Blockchain Explorer is a tool that allows browsing and analyzing data stored in the blockchain network. It enables tracking transactions, displaying address information, and providing detailed insights into blocks. BTD. BTD stands for Buy the Dip, which represents an investment strategy involving the purchase of assets, including cryptocurrencies, when their price is lower than before. The goal of this strategy is to buy assets at a lower price, potentially yielding higher profits in the future when the price of these assets rebounds to a higher level. This approach can be applied to various assets, including cryptocurrencies, stocks, commodities, and other financial instruments. Bug bounty. A bug bounty program is where cryptocurrency creators offer monetary rewards or other benefits for finding and reporting bugs or vulnerabilities in their system's security. The aim is to ensure the security and stability of the network while encouraging collaboration and feedback from the community. Build. In the world of cryptocurrencies, building refers to the creation of software or applications tailored for the cryptocurrency market. It involves a process where programmers and engineers develop and test software to ensure it functions correctly and meets user requirements. Bullish is a term used in the investment world to describe a situation where someone anticipates that asset prices, including cryptocurrencies, will rise. A person with a bullish outlook is optimistically inclined towards the market, believing that prices will increase in the near future. CBDC stands for Central Bank Digital Currency. It is a type of digital currency issued by a country's central bank and operates within its territory. CBDC serves as a virtual equivalent of physical money and aims to complement traditional forms of payment, eventually phasing out the money we know today and eliminating cash transactions. CBDC is typically based on blockchain technology or a similar system, ensuring the security and immutability of transactions. It can function in various ways, such as being stored in a digital wallet or a bank account. The key difference between CBDC and traditional forms of payment lies in its direct issuance by the central bank, bypassing commercial banks. CBDC offers potential benefits, such as faster and cheaper transactions. However, what's crucial for us as citizens are the risks associated with the widespread adoption of this payment method. CeFi is an acronym for Centralized Finance, referring to traditional central financial institutions such as banks, exchanges, and investment funds that operate based on centralized management structures controlling the flow of finances. In the context of cryptocurrencies and blockchain, the term CeFi is used to differentiate traditional centralized financial institutions from decentralized finance, which operate on decentralized systems and smart contracts instead of centralized institutions. Within CeFi, investors and users utilize services offered by central financial institutions, such as cryptocurrency exchanges, online wallets, and lending platforms for transactions and managing their funds. While cefi offers several advantages such as user-friendliness, stability, and security, it also comes with certain drawbacks, including increased control and dependency on central institutions, high fees, and limitations in accessibility. CX, centralized exchange, refers to a centralized marketplace. In the case of CX, all transactions occur through a central platform, acting as an intermediary between buyers and sellers. This exchange operates similarly to a traditional stock exchange, where investors can buy and sell company stocks. On CX, users can trade various popular cryptocurrencies such as Bitcoin, Ethereum, Litecoin, or Ripple. CX platforms offer several advantages, including fast transaction processing, user-friendly interfaces, and the security of funds ensured by various safety measures. However, they are centralized platforms, meaning there is a risk of the platform becoming a target for hacking attacks. Additionally, due to regulatory compliance, these platforms often impose restrictions on user accessibility, identity verification, and other aspects. In recent years, gaining popularity as an alternative to CEX are decentralized exchanges, where transactions occur directly between users without the involvement of a centralized platform. Cloud mining. Cloud mining is the process of mining cryptocurrencies, where investors utilize services offered by companies providing computational power and necessary hardware for performing calculations required for cryptocurrency mining. In cloud mining, investors don't physically own or buy the hardware needed for mining cryptocurrencies. Instead, they rent computational power and mining capabilities from external providers. However, it's crucial to note that cloud mining services often come with costs and risks. These costs can stem from rental fees for computational power, as well as expenses related to hardware maintenance, such as electricity and cooling costs. Moreover, the risks associated with cloud mining can arise from cryptocurrency market instability, uncertainty about contract terms, and the quality of services offered by providers. Additionally, many companies offering such services turn out to be scams. Coin or token. The term coin refers to individual units of digital currencies. Each cryptocurrency has its own monetary unit, referred to as a coin or token. These terms are often used interchangeably, but they have slightly different meanings. A coin, or in loose translation, a currency, is a cryptocurrency that has its own independent blockchain and functions as a standalone payment system. On the other hand, a token is a digital unit issued on an existing blockchain, such as Ethereum or Binance Smart Chain. Tokens can represent various values, such as currencies, commodities, stocks, voting rights in decision-making systems. Unlike coins, tokens are not independent cryptocurrencies, but rather represent some value within an existing blockchain network. Depending on their functions, tokens can have different features, such as security, guarantees, voting rights, and dividend entitlements. Cold wallet. A cold wallet is a type of cryptocurrency wallet that operates offline, meaning it is not connected to the internet. This is a safer solution compared to storing cryptocurrencies in a hot wallet, which is an online wallet connected to the internet and may be more vulnerable to hacker attacks. A cold wallet allows the storage of private keys, which are necessary for conducting cryptocurrency transactions and transfers. Because it is disconnected from the network, remote takeover of the wallet is impossible. Currently, this is the safest way to store your funds in the long term. A custodial wallet is a type of cryptocurrency wallet where the user entrusts control of their cryptographic assets to a third party, such as a cryptocurrency exchange or trading platform. In this case, the custodian is responsible for securely storing the private keys and managing the user's wallet. On the other hand, a non-custodial wallet is a wallet where the user has full control over their cryptocurrencies, and the private keys are stored solely by the user. In this scenario, the user can access their funds using a special seed phrase or password, eliminating the need to rely on other entities and allowing for independent wallet management. Custodial wallets might be more convenient for beginners as they don't have to manage private keys and the risk of losing them. However, non-custodial wallets offer greater privacy and security since the user is solely responsible for their funds and doesn't need to trust any third party. Dapps, short for decentralized applications, are applications that operate on blockchain or other decentralized infrastructures. In simpler terms, these are applications that leverage blockchain technology to achieve distribution and security. Dapps differ from traditional applications in that they are decentralized, meaning they are not controlled by a single central institution or company. Instead, they run on multiple nodes within a blockchain network, ensuring their reliability, transparency, and resistance to censorship. Day trading is a trading strategy that involves buying and selling assets such as stocks, currencies, cryptocurrencies, and others within the same day. The goal of day trading is to capitalize on short-term fluctuations in asset prices to make a profit. Trading financial assets always carries risks, and day trading is one of the most high-risk trading strategies because investors often make quick decisions based on short-term trends and price fluctuations. Day trading also requires extensive knowledge of markets and financial instruments, analytical skills, and good emotional control, as stress and time pressure can lead to impulsive decisions. Dollar cost averaging is an investment strategy that involves regularly investing fixed amounts in a particular financial instrument, regardless of its current market price. Through this method, the investor buys more assets when prices are low and fewer when prices are high, helping to mitigate the impact of price fluctuations on the overall investment outcome. DCA is considered a relatively safe and easy-to-use investment strategy. Dead cat bounce is a term used in financial markets to describe a situation where the price of an asset briefly rises after a sharp decline, only to fall again. DeFi, short for decentralized finance, refers to financial systems built on blockchain technology that enable transactions without the need for traditional financial intermediaries. This means that DeFi operates in a decentralized manner, without central points of control. The term degen is short for the English word degenerate, which in the context of cryptocurrencies refers to an investor who makes highly risky investment decisions without applying any strategy or analysis, often leading to financial losses. This term carries a negative connotation and is not typically used in a positive context. DEX is short for decentralized exchange, which refers to a decentralized cryptocurrency exchange platform. DEX allows users to buy and sell various cryptocurrencies directly with each other, eliminating the need for intermediaries or central financial institutions. DEX platforms leverage blockchain technology, making the trading process more transparent and secure, giving investors greater control over their assets. A DEX aggregator is a tool that allows investors to simultaneously access multiple decentralized cryptocurrency exchanges to get better prices or improved trading conditions. DEX aggregators automatically compare cryptocurrency prices and other trading parameters across various DEX exchanges, presenting them in one place. This enables investors to find the best deals conveniently. dyor stands for the English phrase, do your own research, which precisely means conduct your own research. In the context of cryptocurrencies, it signifies that investors should thoroughly investigate and analyze a project or cryptocurrency before making an investment decision. This is crucial because the cryptocurrency market is highly volatile, and projects and cryptocurrencies can vary widely in terms of risks and potential benefits. Diversification is an investment strategy where an investor spreads their investments across various types of assets to reduce investment risk and increase the chances of potential gains. ERC20 is a technical standard for digital tokens based on Ethereum, which defines a set of rules and interfaces for smart contracts. Tokens based on the ERC20 standard are compatible with Ethereum wallets and other platforms that support this standard. An exit scam is a financial fraud in which the developer of a cryptocurrency project or other online investment suddenly withdraws from the project, disappearing with the investor's funds. Such scams often aim to extort a large amount of money, and the developers are often untraceable or unable to be brought to justice later on. A falling knife is a situation in which the price of a particular asset rapidly declines, and investors seeking to take advantage of the opportunity to buy at a lower price invest in it, but the price continues to drop. This is a highly risky situation because the price may keep falling, leading to investment losses. That's why it is said not to catch falling knives, meaning long red candles on charts, as you might get hurt. Fee or gas fee refers to the charge users pay for conducting transactions on the blockchain. This fee depends on the network congestion and is paid in a specific cryptocurrency. Fiat currency is the official currency issued by governments and central banks of a country. The term refers to any currency that is not backed by any physical commodity like gold, but derives its value from the government's or central bank's authority. A flash crash is a sudden and rapid decline in the price of financial assets that occurs within a very short period. It can be triggered by various factors, such as sudden shifts in market sentiment, technical issues, or human errors. Typically, within a few minutes or hours, the asset prices return to their original levels, but this doesn't always happen. FOMO is an abbreviation for fear of missing out, which refers to the emotions experienced by investors when they observe the rise in asset prices and fear missing out on the opportunity for profits. FUD is an acronym for the English phrase fear, uncertainty, and doubt. In the context of cryptocurrencies, it refers to the spreading of negative information or rumors aimed at instilling fear, uncertainty, and doubt in people regarding a specific project or the entire market. Google Authenticator is a free smartphone application created by Google that is used to generate one-time authentication codes for confirming a user's identity within two-factor authentication authorization. Two-factor authentication is an authentication process that requires the user to provide two types of information to confirm their identity, typically a password and a one-time code generated in real time. GEM usually refers to a niche, lesser-known cryptocurrency that has the potential for future value growth. These are typically cryptocurrencies that are just starting to develop, do not yet have widespread popularity, but possess unique features or technological solutions that might attract more attention and investors in the future. GitHub is an online platform for hosting and managing programming projects using the version control system Git. It allows developers to collaborate on projects, track changes in source code, and share source code publicly or privately. A governance token is a cryptocurrency used for voting on decisions related to a project or blockchain protocol. Holders of governance tokens have influence over the project's development and can make decisions regarding the functioning of the protocol. The Bitcoin halving is an event that occurs approximately every 4 years, reducing the rewards for miners by half. This means that for mining one block in the Bitcoin network, a miner receives less Bitcoin than before. The purpose of the Bitcoin halving is to control the amount of Bitcoin in circulation. By reducing the miner's reward every 4 years, the amount of Bitcoin that can be mined is limited. This, in turn, affects the stability and value of Bitcoin because the limited supply can lead to a price increase. Hard cap refers to the maximum amount of funds that a cryptocurrency project aims to raise during an initial coin offering or another type of financial campaign. It means that the project team determines the maximum amount of money they want to obtain to develop their project, and once this limit is reached, no more funds will be collected. HODL is a slang term indicating a strategy of long-term holding of assets instead of short-term speculation and frequent transactions. The emergence of this term originated from a misspelling of the word hold in a post on a cryptocurrency forum, where a user stated that they would not sell their bitcoins despite sudden price drops. Hossa, bull market, refers to a situation where the prices of financial assets are rising and investors are optimistic about future gains. However, it's essential to remember that a bull market doesn't last forever, and after a period of growth, there is often a price correction or decline. Therefore, it's crucial to exercise caution and avoid making overly risky investment decisions based on emotions. A significant skill is exiting a profitable position and securing profits before any downturns occur. A hot wallet is a type of cryptocurrency wallet that is connected to the internet. This means that access to it is easy and fast, but it also comes with certain risks because the wallet is more vulnerable to hacker attacks. ICO stands for Initial Coin Offering, which literally means the first coin offering. It is a method of raising funds for the development of new cryptocurrency-related projects involving the initial sale of virtual tokens to investors in exchange for existing cryptocurrencies, typically Ethereum. Infinite mint attack is a type of attack associated with some DeFi protocols where an attacker can exploit a loophole in the code, allowing unlimited issuance of new tokens. This way, the attacker can create additional tokens and sell them in the market, leading to inflation and devaluation of existing tokens. KYC, or Know Your Customer, is a process in the cryptocurrency industry where users are required to verify their identities. It's done to prevent fraud, money laundering, and other illicit activities. Users must provide personal information and documents to use cryptocurrency exchanges or participate in ICOs. The term layer refers to additional layers of software or protocols that are applied on top of an existing blockchain network to enhance its performance or functionality. Different types of layers can be distinguished, depending on their functions and how they integrate with the main network. The most popular ones include Layer 1, the primary blockchain layer on which the entire network is built. It typically contains fundamental functions such as transaction processing and data verification. Liquidity refers to the level at which assets can be bought or sold without significantly affecting their price. The higher the level of liquidity, the more likely buy or sell orders will be swiftly executed at the current market price. In the absence of liquidity, it means that a buy or sell order might impact the market price of the asset. A long position is a term used in the financial market, indicating that an investor buys a financial instrument anticipating its value to rise. The investor relies on the asset's price increasing, enabling them to sell it at a higher price, thus making a profit. Market cap refers to the market capitalization of a specific cryptocurrency, which is the total value of all its units available in the market, multiplied by the current price. This means that the market cap depends on both the number of units of the cryptocurrency and their market value. A masternode is a specialized type of network node that meets specific technical requirements and stores a full copy of a cryptocurrency's blockchain. Masternodes play a crucial role in the cryptocurrency network, aiding in its security and efficiency. To set up a masternode, an investor typically needs to meet certain requirements, including owning a minimum amount of the cryptocurrency and demonstrating technical proficiency. The masternode must be operational at all times to properly support the network. In return for maintaining the network node, the investor receives a portion of transaction fees and block rewards. Memecoin is a cryptocurrency that typically lacks serious or practical applications, with its value often based on internet memes or jokes. These coins usually have low market capitalization and high price volatility. Metaverse is a term that describes a virtual world that combines virtual reality and the physical world. It is an online space where users can create, share, and interact with virtual content, including games, applications, virtual products, and other items. Mining reward refers to the amount of cryptocurrency received by an individual or group of individuals, known as miners, who successfully mine a block of transactions in a blockchain network. This reward is often given in the form of new units of the cryptocurrency, which are generated as a result of mining the block. The mining reward plays a crucial role in the cryptocurrency mining process, as it provides an incentive for users to participate in the process and maintain the blockchain network. Mining pool can be translated as mining cooperative. It functions as a virtual cooperative where miners with their own mining rigs can join forces. The combined computational power of the entire pool is then used to mine a specific cryptocurrency. The coins mined are distributed among participants based on their individual computational power. Joining a mining pool allows miners to collectively increase their chances of successfully mining new blocks and earning rewards. Moonbag is a colloquial term referring to an investment portfolio intentionally holding onto a portion of a cryptocurrency that has been deliberately retained after a sale. The purpose is to wait for a potential future price increase, enabling a profitable resale. It symbolizes the strategic approach of investors, akin to holding onto a lunar bag of valuable assets, anticipating the right moment to capitalize on the market's upward momentum. NFT, non-fungible token, is a type of digital asset that is unique and indivisible. This means it cannot be exchanged for another asset of the same value because there is no identical copy. Some potential applications of NFTs include ownership of digital assets and collections, integration with video games, support for artists and content creators, supporting charitable causes, virtual real estate. However, it's essential to note that these possibilities are speculative, and the actual applications of NFTs in the future may vary or change depending on technological advancements and market developments. The term no coiner refers to a person who does not own any cryptocurrencies. This term is commonly used by cryptocurrency holders to describe individuals who are skeptical or distrustful of blockchain technology and cryptocurrencies. On-chain data refers to any information recorded directly on the blockchain of a specific cryptocurrency or blockchain network. It is an integral part of the blockchain network and is used for transaction verification, fraud detection, block generation, as well as for conducting analyses and generating statistics related to the network and its users. Since on-chain data is public, every blockchain network user can trace and examine it, constituting a crucial element of transparency and verifiability within the network. Paper wallets used for storing digital currencies are typically software programs that facilitate blockchain updates during transactions. Paper wallets differ from so-called hot wallets as they operate offline, without internet access. Cryptocurrency users wanting to store their assets in a paper wallet usually print the private key on a sheet of paper. Paper wallets were particularly popular in the early years after Bitcoin's inception. Nowadays, cryptocurrency users tend to employ different methods for storing their assets, such as hardware wallets like Ledger or Trezor. Passive income refers to a type of earnings that is generated without the need for active work. It means that an individual receiving passive income doesn't have to engage in physical or mental labor to earn money during a specific period. Peer-to-peer is a communication and data exchange model between computers without the need for a central server. In a peer-to-peer network, each node or computer operates as an equal partner, capable of both downloading and uploading data simultaneously. A phishing attack is a type of cyber attack that involves online scams aimed at extracting confidential information such as passwords, credit card numbers, personal data, and other sensitive details. Phishers create fake websites, emails, or text messages that closely resemble real websites and messages, deceiving users into divulging sensitive information. Proof of stake is one of the consensus algorithms employed in cryptocurrency blockchains, enabling transaction verification and block creation within the network. In the POS algorithm, instead of relying on computational power as in proof of work, network nodes use their cryptocurrencies as stakes to be chosen for block generation and receive rewards. POS was designed to address issues related to costs and energy consumption associated with proof of work. It is more economical and environmentally friendly, requiring less computational power and specialized hardware than POW. Proof of work is one of the consensus algorithms employed in the cryptocurrency blockchain, enabling transaction verification and new block creation. In POW, network nodes compete to solve intricate mathematical problems, validating transactions and forming new blocks. The node that first solves the mathematical problem is rewarded with cryptocurrency and transaction fees. Individuals participating in this problem-solving process are called miners, and the process itself is known as mining. POW demands substantial computational power and specialized hardware, consuming significant energy to secure the network. In the cryptocurrency world, there's a playful term for traditional employment, mining fiats, referring to the concept of proving one's work in the traditional job market. The private key is a string of characters used to unlock and sign cryptocurrency transactions. It is a fundamental security element protecting the funds stored in a cryptocurrency wallet, as it grants access only to the owner. It's crucial to keep the private key secure, preferably encrypted and away from third parties' reach. There's a saying, rightfully emphasized, that if it's not your keys, it's not your crypto. Hence, under no circumstances should anyone share their private keys. Pump and dump is a financial fraud strategy where groups manipulate the price of assets such as stocks or cryptocurrencies by aggressively promoting them on social media and other communication channels to drive up the price. Then, when the price rises and investors buy these assets, the fraudsters sell their positions, causing a sudden price drop and leaving investors with significant financial losses. Rekt is a slang term referring to significant financial losses resulting from investments. The expression is derived from the English word rekt, meaning damaged, demolished, or wrecked. A roadmap is a document or action plan that outlines the goals and direction of a project, company, or organization for the future. It typically includes a list of projects, features, and timelines to be realized. Return on investment measures the efficiency of an investment by determining how much profit it generates in relation to its costs. ROI is typically expressed as a percentage and is calculated as the ratio of profit to investment costs multiplied by 100. ROI is a valuable tool for investors looking to gauge the effectiveness of their investments and compare various investment opportunities. The higher the ROI, the more efficient the investment, leading to greater profits in relation to costs. Rollup is a scalability solution for blockchain networks that enables the compression of multiple smaller transactions into a single, larger transaction. Specifically, many smaller transactions are grouped together and processed off the main blockchain in a layer called rollup. Then, only the final state of these transactions is recorded on the main chain, saving space and improving efficiency. cefi is a term originating from the cryptocurrency community and is used as an acronym for the phrase "funds are safe," indicating that the assets stored in a particular system are secure and protected against various threats such as hacking attacks, technical glitches, fraud, or other unforeseen events. cefi gained significant popularity after the cryptocurrency exchange. Binance announced the establishment of the Secure Asset Fund for Users, designed to safeguard users' funds in case of security incidents. However, beyond this specific initiative, the term cefi is generally employed as a symbol of security and assurance for users across various cryptocurrency systems. Satoshi is the smallest unit of Bitcoin, named in honor of the creator of Bitcoin, who used the pseudonym Satoshi Nakamoto. One Satoshi is equal to 0.00000001 part of a Bitcoin. Satoshi is used to accurately represent the value of small transactions made in BTC. Since the price of Bitcoin is quoted in relation to the dollar or other currencies for very low transaction values, using whole Bitcoin units becomes impractical. Hence, Satoshis are employed, enabling transactions of values less than 1 BTC. A scammer is an individual who operates with the intent to deceive others for financial gain or other benefits. This can be someone online using various fraudulent techniques, such as phishing, to obtain confidential information or extort money from others. A seed is a string of random words used to recover a cryptocurrency wallet in case it is deleted or lost. The seed typically consists of 12, 18, or 24 words, which, when entered into a new wallet interface, allow the user to regain access to the funds stored on it. Shilling is the practice of promoting a cryptocurrency or any other product to increase its popularity or price, usually through false or exaggerated claims or opinions. Shilling is considered unethical and illegal because it misleads people and can lead to significant financial losses. Short selling, a practice commonly used in stock and cryptocurrency trading, refers to the act of selling assets that the seller doesn't actually own. The goal is to buy back these assets in the future at a reduced price, thereby securing a profit. Essentially, it's a wager on the expected decrease in the value of a particular asset. A smart contract is a computer program written in a programming language that enables the creation and enforcement of agreements between two or more parties in a decentralized, automatic, and intermediary-free manner. Smart contracts are utilized in various projects based on blockchain technology, and their distinctive feature is that once created and deployed, they operate in a decentralized and human-independent manner. A stablecoin is a type of cryptocurrency designed to maintain a stable value relative to a specified asset, such as the US dollar or euro. In principle, the issuer should have a corresponding reserve of each token in the fiat currency it represents. Algorithmic stablecoins utilize a special algorithm that autonomously adjusts the supply to maintain a stable value. In the case of algorithm-based stablecoins, the reserve could be another cryptocurrency. Staking is the process of locking a certain amount of cryptocurrency as collateral in a proof-of-stake blockchain network to secure the network and receive rewards for maintaining it. Users who lock their cryptocurrency as a deposit receive rewards in the form of new tokens or transaction fees. Testnet is a separate version of a blockchain that allows developers and users to test new features, applications, and protocols without using real cryptocurrency tokens. It enables testing of various scenarios without the risk of losing real funds. To the moon is a popular phrase that signifies a rapid increase in the value of a particular cryptocurrency or investment, indicating a sharp upward trajectory. It's a metaphorical way of suggesting that the price is soaring towards the moon. Burning tokens, also known as token burning, is the process of permanently removing a portion of tokens from circulation to decrease their quantity in the market and increase the value of the remaining tokens. Burning can be applied for various reasons, such as limiting the supply, encouraging further investments in the project, or maintaining the stability of token values. Tokens are burned by sending them to an address without a private key, making it impossible to reuse them. This practice helps shape the token economy and can enhance the perceived value of the remaining tokens in circulation. In cryptocurrencies, the term whale refers to an individual or entity holding substantial amounts of a specific cryptocurrency. Whales have the power to influence cryptocurrency prices significantly due to the sheer size of their transactions, which can cause substantial market fluctuations. A white paper is a document that provides detailed information about a project, usually related to a new cryptocurrency or blockchain technology. It may include information about the project's goals, implementation methods, business model, technical aspects, and the cryptocurrency's economy. Thank you for your time spent with this audiobook. I hope I managed to clarify many concepts and aid in understanding complicated topics, enabling you to feel more confident in industry discussions. At the end, if you are looking for a complete cryptocurrency training, check out my crypto guide on Udemy. The link is below this video. If you like my material, please leave a thumbs up. If you have any questions, ask them in the comments. Good luck.